Following recent announcements by the ECB and Fed that both would engage in open-ended intervention and stimulus, there seems to be growing concern about the risk of hyperinflation and the danger to the stability of the global monetary system. Joining us on the desk tonight to talk about this and many other related factors, Vunani Fund Managers Tony Bell and Wayne McCurry from Momentum Investments. Welcome to both of you. Good to have you here. So plenty to talk about the economy, and this is, if we just look at what's happened today, nervousness. We've had Spain, we know it's been at the center of this most recent storm, Wayne, and with a downgrade of the regions and still the Prime Minister holding back on seeking bailout.
Yeah. Look, I mean, first of all, on Spain, I mean, we all know the stories there, it's all part of the European issue, but yet the Spanish bonds have actually fallen quite dramatically over the last 3 months. The yields have dropped, I think, from 6.5 to about 4.5 or 5. They've dropped dramatically. And today they've only kicked up a minuscule amount. So, you know, I don't think that much has changed economically. You know, in other words, the underlying economy is still poor, but maybe not a disaster. US corporate earnings seem to be disappointing a little bit now, after being quite good at the start of reporting season. But I think the biggest single factor is markets have been incredibly strong worldwide in the last 3 months. So a little bit of weakness is not untoward. Maybe it was sparked by the downgrade of the Spanish regions, but that's just the reason why it fell today. The reason why you're seeing weakness is just been incredibly strong over the last 3 months. So it's actually quite normal. This, I wouldn't say all of a sudden that the world economy outlook has changed. It's still poor, but interestingly enough, in Europe, the bond yields are going the right way. The Italian bond yields are falling, the Spanish bond yields are falling, and the German bond yields are rising. And that's actually
sort of a normalization.
Relatively, well, you're a long way from that, but at least you're heading down the right path.
Right. And Tony, on the US earnings results, Wayne vaguely touched on that. Credit Suisse, for instance, this morning said that about 60% of the companies have surprised on the positive side. So this is a bit lower than what we've seen in the last, 4, 5, 6 quarters.
Yes.
But a lot of it obviously depends on what those expectations look like.
Yeah. There's been quite a significant downgrading of expectations, both locally and internationally. A lot of South African companies have also guided low in certain sectors. So what you're seeing is really just a balancing out of expectations meeting reality. By and large, when we look through into corporate US, we find companies in good shape. The balance sheets are strong, cash flows are robust, and companies are doing very well in a very difficult environment.
Yes.
Obviously, the Fed's policy is helping a lot. With reference to your earlier comment about the risk of hyperinflation, we don't particularly see that because we still see quite a low level of aggregate demand in the economy. It really is only the consumer that's keeping the US economy going. We're starting to see some nice pickup in housing stats. The number of houses that are available for sale have come down. Dr. Bernanke is all in, his foot's firmly on the gas. And so that kind of factors through into the broader corporate environment where you've got fits and starts, but in aggregate or in average, it's not looking too bad at all. Yeah. I think the price action we're seeing today is very much a question, if you like, of shifting gears. The market has been on absolute liquidity steroids, a little bit of a sugar rush. That sugar rush is coming off and the market's starting to look at the sustainability of corporate earnings, given the downgrades, starting to question whether the ratings that we've pushed stocks to are appropriate.
So Wayne, I think you've almost implied this with your comments. It's almost a relief when we see this, because there's been such a disparity between valuations and fundamentals.
Yeah, look, I mean, and Tony, certainly you would like your input in this. I don't think overseas valuations and stock markets are stretched. Of course, the economies are in far worse shape than, let's say, on average for the last 20 years. But the stock market, I think, by and large, takes that into account. Obviously, in our domestic market, we have some incredibly expensive shares. Okay. And, I was looking at this today. 4 years ago, no one could touch the construction shares. They were just the king of the castle. They were just ruled the world.
Now no one wants to touch them.
Now no one wants to touch them. And now Mr. Price, and this is not my study, but Mr. Price's market cap is bigger than the whole market cap of the building and construction sector. Whereas I think 4 years ago, one company in the building and construction sector was bigger than the whole retail sector.
Yes.
Now the retailers obviously have had a wonderful 3 or 4 years on a, on an absolute and on a relative basis. But you just got to say, these shares at 22 to 28 to 30 PEs are just not value. So to me, that's still where the danger sits.
Just some
the rest of the
clarity.
market's okay.
Wayne, on your opening comments here, so the disparity that we see in the South African market between the economy and valuation, so that disparity is not as pronounced in the US and the European markets?
I don't think so, no.
Okay.
But within our market, of course, we have the resource sector, which has got virtually nothing to do, its valuation has got nothing to do with South Africa.
Yeah.
But then the banks and the retailers are obviously very specifically South
Right.
African.
Tony, your comments on that?
Yeah, we find an interesting insight when we look through as to, and I can't resist mentioning it, what Benjamin Graham used to refer to as earnings powering companies. The companies that have been able to generate positive real earnings growth and sustain them have been pushed in some sectors like the consumer services sector to very, very high levels. What we do back at the shop is we have a look to see how much value the companies would need to deliver to shareholders for those prices to be paid back, a sort of a value-driven PE. And we find that Mr. Price, you would have to wait for the next 7 to 8 years to get your money back at current share prices in terms of the new value that Mr. Price is going to create. So yeah, the companies are particularly stretched from that valuation perspective. If you flip to the other side, the mining shares, they appear to be cheap on a rating, but the thing that they singularly lack is earnings power. So what one has to try and do is blend or sort of synthesize the macro view in terms of, will the global economy surprise to the upside in 2013? Will China reflate a little bit more quickly given the pressure that's being brought to bear because of the lower exports through to Europe, and also the lack of profitability in many of Chinese industrial sectors? Will additional stimulus come in, take up some of the slack in some of the inventory that's built up and allow the mining companies to re-establish a bit of earnings power? The strike actions don't help in that regard. So the market has almost overvalued what it can see, but it's undervaluing that what it can't see.
So it's cheap for a reason.
It's cheap for a reason.
So linking this to your latest economic report, so you refer to the hyperinflation. So what you're saying is there's a greater risk of deflation in the market now globally than there is of hyperinflation. In fact, you start off your report by saying the economic outlook, and I assume you mean globally, today is not much better than what it was 3 years ago at the beginning of the first QE. So all this effort, and all it's done is prevented us falling down the precipice.
Yeah, I think just to contextualize that a little bit differently, I say the outlook is possibly as uncertain. And what I mean by that is that we're still dealing with this sort of two-step approach. The central banks are trying to stimulate for different reasons. The Fed is stimulating to try and get the economy going. The ECB is stimulating to avoid a banking crisis. And China has been reducing stimulus to try and avoid too much inflation. So without getting into too complex a picture, we really are looking at 3 different reasons for the stimulation, for the stimulus packages to come through. What we find if we look into the underlying markets and how markets reflect that is the US in particular has responded very positively, the US equity market, to the prospect of better than consensus growth coming through into 2013. Whereas in Europe, as Wayne said, the peripheral Eurozone is still in desperate trouble. And what we'd be looking for there is an easing up on all these very, very draconian austerity measures in order to allow a bit more of a balanced policy approach where you do have the prospect of some sort of recovery in those underlying economies. We're starting to see tentative signs in Australia, in Italy, but Spain is still pretty stretched at the moment. So the more realism that creeps into policy, the policy dynamics, I think the more the markets respond positively.
Right.
Tony, when you look at all the money that's been pumped into the system, I mean, it seems like it is virtually countless billions because it's actually trillions.
Trillions.
There's no such thing as a free lunch.
Sure.
What is going to be the consequence of
Yeah.
all of this, of all
Well,
of this money?
that's the really big question, and the big answer then does turn itself towards hyperinflation. At the moment, the risk of inflation is not high because, from an economic perspective, the concept of the velocity of money creeps into the debate. The
Well, there's no
velocity of money
demand,
is
yeah.
extremely low, which measures the demand for money circulating in the economy. What ultimately happens are two things: inflation and the ability of the central banks to extract themselves from rising inflation. One of the things I cover in the quarterly report, when just before Lehman's went bankrupt, the leverage ratio was sitting at 35-1. According to our calcs, the Fed's leverage ratio has now moved up in excess of 50-1. And the maturity profile of its debt has extended quite a bit. Most reserve banks around the world have got durations of under 2 years. The Fed is now sitting closer to the 6-year mark. So the simple answer is that if the Fed were to raise interest rates by 1%, they would virtually wipe out their capital base. And that's why a lot of commentators are starting to call into question the sensibility of the approach and whether this is not one step too far.
But I mean, you've got to get a weaker dollar before any of this comes to pass.
Weaker
because
dollar
as long
will
as people
happen.
still believe in the dollar,
Yeah.
you can finance debt indefinitely.
Of course you can. That's absolutely right.